Hello and welcome. My name is Partho Majumdar. In this video, we will discuss about spreads. Now, spreads is a options trading strategy. Now, we know that in options trading, the buyer of the option can have profit, which is unlimited. However, the buyer also has a possibility that he can suffer a loss. The loss what the buyer can suffer is limited to the amount of premium what is agreed in the options contract. Now, spreads is an option strategy where we try to or lower the amount of loss what a buyer can suffer from trading in options. However, this possibility comes at a compromise that the buyer strategy will make a limited amount of profit. The profit will be capped at a certain amount. So, spreads is essentially a strategy for trading in options where we lower the possibility of loss or the amount of loss what a buyer can suffer at the price that the buyer will also make a limited amount of profit. Let's go through this in details. To use the spreads strategy, the trader has to buy a option and also has to sell a option. Now the option which the trader will buy and sell has to be on the same underlier at the same quantity. We know that options requires a few things, that is it has to have an underlier and the underlier has to have a strike price, it has to have an expiry, and it has to have a quantity, the lots, number of lots, what will be traded in the option. The option can be a call or a put. In call is utilized when we want to buy an underlier, and put is used when we want to sell an underlier. So now in a spreads strategy, we have to buy our option. The option we buy can be a call or a put. So if it's a call option that we buy, to use spread strategy, we must also sell a call option for the same underlier. However, the buy and the sell of the option will be made at different strike prices. Like I mentioned earlier, the quantity has to be the same and the buy and the sell option has to be exercised on the same expiry date. So this is important. So we summarize once again. So the trader in a spreads strategy has to buy and sell an option, either a call option or a put option. Now, if it's a call option, he has to buy a call option and sell a call option. If it's a put option, he has to buy a put option and sell a put option. The option has to be on the same underlier. The strike prices of the buy and sell will be different. However, the quantities will be the same and the expiry date has to be the same for both the buy and the sell option. Now, when we use a call option in a spread strategy, it is called the call spread, or it is also called the bull spread. And when we use a put option in the spread strategy, it is called a put spread or a bear spread. Now, a spread strategy is utilized by the investors when they expect that the underlier will either rise or fall by a certain amount only. It will not rise indefinitely or it will not rise too much. The amount of rise or the amount of fall will be limited. So in a call option where investor expects that the underlier will rise only by a limited amount, he will utilize the call spread strategy. Similarly, in a put option, if the investor expects that the underlier will fall by only a small amount, he will use a put spread strategy. Before we proceed further on the spread strategy, let us take a small detour and understand about premium. Now, in option trading, we know that a premium has to be paid by the buyer to the seller. The premium, what the buyer pays to the seller or what is agreed in the contract, depends on a few factors. The first factor is the price of the underlier. If the price of the underlier is higher, the premium also is likely to be higher. Also, we know that the option is for a specific period of time. So the option, we have to agree that it is a 1 month option or a 1 quarter option or a 1 day option. Now, the amount of time that is left in the option, that determines the price of the premium. So if the amount of time left is small, then the premium will rise. If the amount of time left is more, the premium will fall. Another important thing to notice is that in contracts which are in the money, the premium will rise, and which are out of money, the premium will fall. So let us understand a little bit about what is in the money and out of money. Let's take a call option. We know that in a call option, the premium will be the maximum loss what a investor or a buyer can suffer, and the possibilities of profit is unlimited. So this is the possibility. So here is the strike price at which the call option will be purchased, and this is the amount of premium what will be paid by the buyer to the seller. So here is the break even point, and after this point the buyer makes a profit. So the when we are in the region where the buyer is making a profit on the call option, supposing the market price is here, then the buyer is making a profit. So this area, when the market price is in this area, we will say that this is in the money. Now, any at beyond below the break even point in a call option, that is on this direction, the buyer will lose money. So if the market price is anywhere here, if the market price is anywhere in this region, then the buyer is going to lose money. So in that case, we will say that it is out of money. And at the break even point, if the market price is at the break even point, then we will say it is at the money. So with this small detour, now let's get back to the spread strategy. First, let's discuss a call spread. So just as recap, what is a call option? In a call option, we will want to buy a underlier, and we will fix a strike price for the underlier. So this is the strike price which we fix for the buying of the call option, and we agree for a premium. So this is the amount of premium what we have agreed. So in this example, we are buying a call at $102 strike price and a premium of $3. So this is $3. So our expense is at this point, and we are expecting, because it's a call option, we are expecting that the price will rise. So as the price rises, it will hit a point where we will break even, and beyond that, if the price rises, then we will make a profit. So this is the profit which is unlimited. However, if the price falls below the strike price, we are protected that our loss will be maximum, that is the amount of premium what we have paid. So this is the maximum loss what we can suffer from this call option. Now in a spread strategy, we are trying to reduce this loss. So this is the loss which we are having right now. In a spread strategy, we are trying to reduce this amount of loss. To do that, we will also purchase a sell call. So this is a sell call, and the sell call will be made at a strike price which is here. Now, the significant thing is that the strike price of the sell call should be greater than the strike price of the buy call. So this is important. So this strategy is that the strike price of the sell call should be higher than the strike price of the buy call. So the sell call strike price is here. And second important thing is that the amount of premium that we agree for the sell call should be less than the amount of premium that we agree for the buy call. So this is the premium for the sell call. The sell call's premium, this amount should be less than this amount. So here we have taken an example where we are striking a sell call at $107 and agreeing to a premium of $1 for this sell call. Under this circumstance, we can exercise a call spread if we exercise the buy and the sell, both the options, at the same expiry date. This is important that the expiry date has to be the same. And already I have told you that the amount of quantity that is traded in both the buy call and the sell call should be the same, and the underlier should be the same. Now that we have understood how to set up a call spread, let us go through the details of profit and loss under call spread. First thing to notice is that when we buy a call option, we agreed to this premium. This premium will be paid by the buyer to the seller. So in our case, the investor who buys this call option will have to pay this premium of $3. And he also buys a sell call. So this premium will come to the investor. So this $1 premium which is agreed for the sell call, this $1 will come to the investor in case he makes a profit on the sell call. So the net premium, what the investor is going to pay is the premium paid for the buy call minus the premium paid for the sell call. So the net amount is that this amount minus this amount will be the net premium what the buyer will pay. So the net amount comes to this much. That is, in this case, $3 minus $1. That is $2. So you notice that by using a call spread, the investor has lowered the premium what he will ultimately have to pay in case he suffers a loss. So here we notice that the maximum loss in the call spread what the investor will make is lowered from this level to this level. So this is the first thing you notice, that we have lowered the amount of loss what the investor can make. So the maximum loss can be at the most the net premium paid, and the net premium paid is the premium paid for the buy call minus premium paid for the sell call. So far, we know that if the market price of the underlier falls below the strike price of the buy call, then the amount of loss will be limited to the net premium paid by the investor. So this portion we have analyzed so far. Now let us analyze the portion where the market price is greater than the strike price of the buy call. So this is the buy call. So let us see what happens when the market price increases beyond this point. Let us first take a point in this particular example where the market price is $104. So here we are in $104. So even the market price is $104, let's see what happens. So we have two positions. One is the buy call and one is the buy call that is here, and one is the sell call which is here. So the position from the buy call is that the market price is at this point, which is greater than the strike price of the buy call. So the trader will exercise the call option. When he exercises the call option, he makes a profit, that is $104, the market price minus the strike price minus the premium what he has paid, and he suffers a loss of $1. So from this, at this position, he is suffering a loss of $1, which is here. And from the sell call, what is happening is that the $104 in our example is less than the strike price of the sell call. So the strike price of the sell call is here, which is greater than the $104, which is the current market price. So in this case, the buyer of this sell call will not exercise the call option. So when he doesn't exercise the call option, our investor will get the premium, which is $1 in this case, from this sell call. So he will make a profit of $1 from the sell call. So as a result, what will happen is that his net position is that he made a loss of $1 from the buy call and he made a profit of $1 for the sell call, and so his position is squared at $0. That is, he neither makes a profit nor a loss. So in this case, here at $104 in our example, the investor will break even. Now this can be formalized in a formula. The formula for break-even point of a call spread is that it is the strike price of the buy call plus the net premium paid. So strike price of the buy call is here, $102. The net premium paid is $3 minus $1, that is $2. So 102 plus 2 is 104. So when we analyze the position on $104, we see that the break even is happening for the investor. So notice that from the strike price of the buy call till the break even point, the investor is still making a loss, though the loss is lower if he had just bought the buy call. So if he had just bought the buy call, his loss would have been at this point. However, the loss is lower at this point. So far, we have discussed the investor's position as long as the market price has risen to $104 where the investor breaks even. Now let's take another position where the market price has risen to $107. This point is significant because this is the strike price of the sell call what the investor has made. So the investor made a sell call at $107 at a premium of $1. So let us analyze what happens at when the market value reaches $107. Now $107 is greater than the strike price of the buy call. So the investor will exercise the buy call. So this is the buy call. The investor will exercise the buy call at this point. When he exercises the buy call, he makes a profit. The profit is $107, that is the market price, minus the strike price of $102, minus the premium of $3. So he makes a profit of $2. Now $107 is the strike price of the sell call. So the buyer of the sell call will not exercise the call option and just forego the premium. So when the buyer of the call option forgoes the premium, he will make a loss of $1 and the profit of that $1 will come to our investor. So the investor makes a profit of $1 from the sell call. So what happens to the investor in net is that he makes a profit of $2 from the buy call and he makes a profit of $1 from the sell call. So his net profit is $3 profit. We will see that this is the maximum profit what the investor can make from this call spread. So we just a note that the formula for the maximum profit is that the strike price of the sell call minus the strike price of the buy call minus the net premium paid. So this is the strike price of the sell call, that is $107. So $107 minus the strike price of the buy call, that is $102, and the net premium minus the net premium. The net premium paid was $3 minus $1. So this is $5 minus $2, which is equal to $3. So this is the maximum profit which can be made in a call spread that is our example. We will see that whether this is holding true or not. So what we have done is that we have reached a position where we have a fixed amount of loss which is lowered, and we broke even at this point, $104 in our example, and at $107 we are making a profit of $3. Now let's study what happens when the market price is $108. That is, we are at this point. Notice that $108 is greater than the strike price of the sell call and also the strike price of the buy call. So in this case, both the sell call and the buy call will be exercised. Now, from the buy call, the profit will go to our investor, that is $108 market price minus strike price of $102 minus the premium paid of $3. So he will make a net profit of $3 on this buy call. From the sell call, because the buyer will exercise the sell call, our investor, his position will be that his strike price is $107, the market price is $108, so this is minus 1. He will get a premium of $1, so this is plus 1, and this will make his position as a break-even position in the sell call. So from this we get that he makes a profit of $3, which is coming from here, and he breaks even from the sell call, which is here. So his net position is that he will earn $3. So this will be his profit. Let's study one more case. So we see that the profit is at $3 only. The previous case we studied was at $107. This is the strike price of the sell call. where the profit was $3. So the profit at $108 is also $3. Now let's study one last case where we take the market price at $109, which is here. Again, $109 is greater than the strike price of the sell call and also the strike price of the buy call. So in this case, both the buy and the sell calls will be exercised. From the buy call, our investor makes a profit, that is a market price of $109 minus the strike price of $102 minus the premium of $3. So this makes a profit of $4 from the buy call. And from the sell call, our investor will suffer a loss. So the strike price is $107 minus the market price of $109. This is minus 2 and plus $1 premium he will get from the buyer. So this makes a loss of $1. So here he's suffering a loss of $1. So his net position is that he makes a profit of $4 from the buy call and he makes a loss of $1 from the sell call. So 4 minus 1 is 3. So this is the profit what he will get from this particular position. So this will be a profit. So notice that the profit is going to be $3 no matter how much the market rises. So like we said in the call spread, we are limiting our loss to a lower level, but we are also restricting the amount of profit that we can make if the market turns favorable. So the maximum profit in our example, the investor can make is $3 per unit, and the maximum loss the investor can make is $2 per unit. So this is a call spread where we notice that we are reducing the possibility of the amount of loss that we can make, but we are also limiting ourselves to a certain level up to which we can make a profit. Now let us discuss the put spread. The put spread is a strategy in which we buy and we sell a put option. So here we know that this is a put option which is purchased. So in this purchased put option or a buy put, the limit, there is unlimited profit which is possible for the buyer and there is a limited amount of loss which is possible for the buyer. The reverse is for the sell of a put option where we will have a limited amount of profit and we will have unlimited amount of loss. So now in a put spread, we will have to purchase a put option and we will have to also sell a put option. The strike price at which the sell option will be purchased is going to be greater than the strike price of the put option which will be sold. This is important. The strike price of the put option which will be bought will be greater than the strike price of the put option which will be sold. This is the first condition. Second condition is that the amount of premium what we pay for buying a put option should be greater than the amount of premium what we pay for selling a put option. The other conditions of a spread remains the same, that the underlier has to be the same, the quantity traded has to be the same, and both must be exercised on the same expiry date. Now let us discuss the put spread under different market conditions. The first condition we consider is that when the market price of the underlier is at the strike price of the buy put, that is here. So here we notice that our example is that we make a buy put at rupees 6900 at a premium of 100 rupees and we make a sell put at 6700 rupees at a premium of 50 rupees. So the strike price of the buy put is greater than the strike price of the sell put and the premium of the buy put is greater than the premium of the sell put. So both the conditions of the put spread is met. Other conditions are that the quantities have to be the same and we will exercise on the same expiry date. So here we are considering a situation where the market price is at the strike price of the buy put. So since the market price is the strike price of the buy put, the investor will not exercise the put option because he will just forego the premium what is there for this buy put, which is 100 rupees, which is here. So he will pay the 100 rupees and come out of this position. That is here. However, we also notice that the sell put is at 6,700 strike price less than the current market value of 6,900. So the buyer of this particular sell put will also not exercise the put option, and he will just pay the premium which we will earn. Our investor will earn this premium of 50 rupees. So this is coming as a earning to him. So the net position is that he gives 100 rupees and gets 50 rupees. So the net premium what he is spending is 50 rupees. So the loss, this will be the loss if the price goes further up. The same way the investors will exercise their put options. So under when the market price is above the strike price of the buy put, the loss will always be rupees 50. However, notice that the loss has now been reduced to 50 rupees from, if he had just purchased the put option, he would have had a loss of 100 rupees where he has lowered his loss to 50 rupees. So now the first thing is met, that the loss is lowered. Next, let us see what happens when the market actually goes down. Now let us study the case when the market price of the underlier is at 68.50. That is here. So at 68.50, the market price of the underlier is greater than the strike price of the buy put. The buy put was struck here, which is greater than the current market price. So the buy put will be exercised. So when the buy put is exercised, our investor, he gets the strike price of 6,900 minus market price of 68.50 minus the premium of 100 rupees what he has paid. So in total, he loses 50 rupees. So this is his loss. However, this market price of 68.50 is greater than the strike price of the sell put, which is at 6,700 rupees. So the buyer of this sell put will not exercise the put option. Instead, he will pay the premium of 50 rupees. So this 50 rupees premium what the buyer of this sell put pays will become a profit for our investor at rupees 50. So his net position is that he made a loss of 50 rupees from the buy put and he made a profit of 50 rupees from the sell put. So he gets a total of rupees 0, which is a break-even point for him. So at this point, our investor breaks even. So as a formula, we can say that the break-even point in a put spread is that the strike price of the buy put minus the net premium paid. So the strike price of the buy put was 6,900 rupees minus the net premium paid is 100 rupees paid for the buy put minus 50 rupees earned for the sell put, which is 50 here minus 6,900. So the value comes to 68.50. So this formula is working. We just noticed that at 68.50 market value, it is the break-even point for our investor. So far we have analyzed up to this portion, that is the market price has risen to 68.50, which is the break-even point for the investor. So till this point, the investor is making a loss. So this is all the area where he is making a loss. Now let us consider the market price as the strike price of the sell put, that is at 6,700 rupees. So at 6,700 rupees market price, this is lower than the strike price of the buy put. So the buy put will be exercised in this case. However, since the market price of 6,700 is same as the strike price of the sell put will not be exercised. So by exercising the buy put, we notice that our investor makes a profit, that is 6,900 strike price minus 6,700 market price minus 100 rupees premium what he is paying. So he gets a total profit of 100 rupees from this buy put at 6,700 rupees market price. The sell put will not be exercised by the buyer of the sell put because it is at the same as the strike price. So our investor will make a profit of rupees 50 from the sell put. So his net position is that he makes a profit of 100 rupees from the buy put and he makes a profit of 50 rupees from the sell put. So his total profit is rupees 150. We will notice in the next few slides that this is the maximum profit what our investor can make. So we note that from the break-even point, he starts making a profit and the profit goes up to 150 rupees at the strike price of the sell put. We can write a formula here that is the maximum profit what is possible is the strike price of the buy put, that is here, minus the strike price of the sell put, that is here, minus the net premium paid, that is this amount minus this amount. We will try to see that whether this formula holds in the next few slides. In the last slide, we saw that at 6,700 rupees, which is the strike price of the sell put, the profit was at 150 rupees. That is, we were here. Now, let us say the market falls further to 6,600 rupees. So, let us see what is the situation at this point. So, when the market is at 6,600 rupees, that is here, this is lower than the strike price of the sell put and also lower than the strike price of the buy put. So, both the buy put and the sell put will be exercised under this condition. So, from the buy put, our investor makes a profit, that is the strike price is at 6,900 minus 6,650 is, we are analyzing at 6,650. So 6,650 is the market price minus the premium of 100 rupees. So he makes a profit of 150 rupees from this buy put. On the sell put side, the current market price is at 6,650. Strike price of the sell put is at 6,700. And our investor gets 50 rupees from the sell put. So if we calculate, we notice that this comes out to rupees 0. So he neither makes a profit nor a loss. You can notice here that the sell put actually breaks even for our investor at this point, that is 66.50. So net position is that he made a profit of 150 rupees from this. He didn't lose anything from the sell put. So he makes a total profit of 150 rupees. So this is his profit. Okay. So notice that the profit has stayed the same at 150 rupees at 66.50 market price also. We take one last case where the market further falls at 6,500 rupees. So here we are somewhere here where the market is at 6,500 rupees, which is lower than the strike price of the sell call and also lower than the strike price of the buy call. So at this point from the buy call, the strike price of 6,900 minus 6,500, the current market price, minus a premium of 100 rupees has to be paid. So the total profit comes out to be 300 rupees, that is 400 from here and minus 100, which comes out to a profit of 300 rupees. From the sell put, the market price is at 6,500. The strike price was at 6,700, that is minus 200. And our investor makes a profit of the premium of 50 rupees. So the net position is that our investor loses 150 rupees from the sell put. So net position from the buy and the sell put comes out to be 300 rupees profit minus 150 rupees loss, which is a profit of 150 rupees. So this is again a profit. So again, notice that the profit is capped at 150 rupees no matter how much the market falls. So we notice that the maximum profit what we can make from a put spread from the example, in our example, it is 150 rupees and the maximum loss we can make is 50 rupees. So it brings to the conclusion that when we exercise the put spread, we reduce the amount of loss that we will make as compared to if we just exercise a buy put. However, by using a put spread, we will also limit the amount of profit that we can make from the put option. We we went through quite a bit of arithmetics in the last few slides, so let us just summarize what we understand by spreads. So the spread strategies is used by the investors when they speculate that the underlier may only rise or fall to a certain limit. So it will not rise drastically or to a very large limit. To a certain limit, it can rise or it can fall. So the spread strategy is used so that the loss from the put option is or the call option is lowered. It is not eliminated, but it is lowered. And for lowering the loss from the call of the put option, the price we pay is that we can only generate a limited amount of profit. So there are two type of spreads. One is a call spread and one is a put spread. In a call spread, we make a buy call and a sell call. And on the call spread, the buy and the sell call both are made on the same underlier for the same quantity, and we exercise both the buy and the sell call on the same expiry date. The only thing is that the buy call and the sell call are made at two different strike prices. So the strike price of the buy call and the sell call is different. Now the put spread is also similar to the call spread. Here also we are using the same underlier and we are taking the same quantity in the buy put and the sell put, and only thing we are changing is the strike price between the buy put and the sell put. That brings us to the conclusion of this discussion. I hope you enjoyed it as much as I enjoyed recording it. Thank you for listening.